Welcome everyone to Vested Interest. This is Shane, and before we get in the video, I'd like to take a moment to thank everyone who's taken the time to watch, comment, and like the video, and a special thank you to those who subscribe to the channel. I really do appreciate it. And if you have not hit that subscribe button yet, go ahead and hit that subscribe. Join us on this journey to financial freedom. Join the Vested Interest community, building a community of like-minded dividend growth investors that we can share experiences, share stocks we're watching. I do a dividend portfolio update every Sunday morning. That's what this video is here. I did add $1,197 to the portfolio. We will go over that in a minute. I also do a stock pick of the day series, typically Monday through Thursday whenever the market is open. If the market is closed, or on occasion I do have other things to do, then I can't make it, then I won't put one out. I did not put one out this Thursday for that very reason. My cousin was getting married, my second cousin actually, so I had to spend some time with family. That stuff happens. That's part of life. I also do a couple of different series monthly where I cover the dividends that were paid out for the previous month, and then I cover the stocks I'm watching as we roll into another month. So if you haven't watched my stocks to buy in July video, go ahead and check that out. It is on the channel. And for the rest of you, well, on this channel, it's not rocket science. In my opinion, the best way to do anything, keep it as simple as possible. It really boils down to consistently investing, buying dividend growth stocks and growing companies with positive cash flow that covers the dividend and companies with a high return on their invested capital. Let's jump into this one. This is, like I said, a portfolio update for July 16th. We did add $1,197. Let's see what we did with that. And also we covered the options if we've done anything for the week, and that is typically where we start. So let's get rolling. And we did have some options, another option play on CVS. We did a cash secured put for $70 strike price, set to close at July 14th. We received $132.45 in premium. That's the options premium, and that's the cash that was added. So we did add this into the portfolio here. That's part of the funds that we saw there on the previous page, part of that $1,100. And it did expire on Friday out of the money, so we were not assigned the shares. So we will look to do this again next week. I'll probably jump that up to $72, maybe write a call for us, depending on what the options are out there and how much we can get in premium. I would look at one at $71, $72, $73 per share. So that's what we'll see on Monday, what that looks like, and pull the trigger on one of those. Hopefully we get it. You can't make someone buy an option, but that is how we do it. We are running it on CVS until we're assigned these shares, and I think it's up to $73 or $74 I'll run this option play up to. Beyond that, I would not be interested in adding it. But again, CVS cash secure put, we received $132.45 in options premium. Next up, dividends started rolling in July 13th and the 14th. We received dividends on both days. First up, July 13th, we received dividends from Medical Properties Trust, ticker MPW. Out of the REITs sector, we received $151.50, which amounted to 15.27618 shares. And we do have the drip set on. That is why it automatically went back in and bought shares of itself. So anytime a position within the portfolio pays out dividends, because the drip dividend reinvestment plan is set, it automatically goes back in and buys shares at whatever the strike price is. This particular day, the $9.91 per share is what we purchased those shares at. Next up on the 14th, Realty Income paid us $34.08. Realty Income, ticker O, is another REIT out of the real estate sector here. And that $34.08 picked up 0.56054 shares of Realty Income. All total, these new shares that the portfolio bought of itself added $19.43. So here you can really see the snowball effect starting to kick in, right? We didn't add any funds to Medical Properties. This is just from the dividends it paid out from the shares already in the portfolio. And same thing with Realty Income. So $185.58 in dividends, which added another $19.43 in annual dividend income over the next year, right? Picking up these shares from those funds. That is the snowball growing over time. The portfolio is now buying shares of the positions in the portfolio itself, whether I add to these shares on a weekly basis or not. And if I was to stop adding new capital, it would continue to do this over time. That is the snowball effect visually in action. Let's keep rolling here. First day, we added some of the new capital here. This is part of that $1,100 and change that we added this week, July 11th. We picked up 2 shares of Johnson & Johnson, ticker J&J, out of the healthcare sector. We picked up those shares at $158.47, and I do believe this may have even dropped down into the 157, but it closed out the week at 159. So that goes to show you can't necessarily time the market just when you see it at a cost basis that you are comfortable with. Pull the trigger, go ahead and add those shares to your portfolio, and don't really worry about it again. I could have got it lower at 157, or I could have waited till Friday and got it at 159. I picked it up at 158. I'm comfortable with that and happy with that. Anything under 160 is a buy for me in Johnson & Johnson right now. So we added $316.95, and those 2 shares of J&J added another $9.52 in passive income over the next year. We weren't done. July 14th, we went back in and added the majority of that $1,197.88 we added this week. $880.93 we added on the 14th. We saw the $316 we added the day before on a couple days before on the previous slide. And with that $880.93, we picked up 1 share of Siboney-Stillwater, ticker SBSW. This one's out of the material sector. I've been nibbling on this one, adding a share, 10 shares, 20 shares here and there. Anything under $8 on this one I've been adding. It was down in the 6s last week, low 7s this week. We picked up that 1 share at $7.22. And Siboney-Stillwater, ticker SBSW, is out of the material sector. This is a mining company here out of Africa. They have mines all over the world, but their main business is out of Africa. We also bought 6 shares of Verizon Communications, ticker VZ, out of the communications sector. We picked up those 6 shares at $34.26. This one here, we've been picking up shares, $35, $36, $37, even $38. Now it's down to $34. I'm going to continue to be nibbling on this one again, and anything under $40 per share. My cost basis, I think, on this one has dropped down to 42. I'm trying to get my cost basis down on this one. So I don't mind continuing to add to this. There's very nice yield on this one right now, 7.5%. So very high dividend yield, payout ratio in the 50% range. So low payout ratio on this one. It is a slow grower, but man, I really like this one right now. So I'm going to continue to add again 6 shares of Verizon Wireless. Pfizer Communication, another one right up against its 52-week low here. 5 more shares of Pfizer, ticker PFE. This is out of the healthcare sector. The healthcare sector, I will say right now, is looking very attractive. We saw Johnson & Johnson on the previous slide, Pfizer here, CVS is, I'm running that cash secured put on. So really the healthcare sector overall, AbbVie I looked at earlier in the week, it's down. A lot of companies in the healthcare sector down for whatever reason right now. Might be a little change in rotation in the markets right now going on. At least that's what I'm thinking. Whenever a whole sector like that kind of comes down, it typically indicates a rotation out of that sector into some other sectors. So I'm taking advantage, even though it is starting to become a bigger portion of my portfolio. I don't really like any one sector to get over 25%. We'll see that here in a little bit and see where it's at, but might have to start backing off a little bit, even though I really see some value. So I'm going to have to really consider it. We'll see what's going on here over the next couple weeks. But 5 more shares of Pfizer at $36.16. Anything under 39 really for Pfizer is a buy for me right now. And last up, but certainly not least, we continue to add to our Nutrien position. This is a relatively new position here last month, so we added 8 more shares. Anything really under $61 per share I like in Nutrien. I'd like to keep it under 60, but I'm not going to be that critical while I'm trying to build out a position. Again, if I can get it under 61 and keep my cost basis in around the $60 range, which that's my cost basis right now, is right at 60. We'll see that here in a minute as well. But 8 more shares of Nutrien, ticker NTR, out of the material sector here. This is a phosphate company. This is a Canadian company, so be aware of that. If you or potash, I'm sorry, not phosphates. Potash is what they sell. This is also a Canadian company, so there are some tax implications here. If you are interested in a Canadian company, you want to check with your tax advisor. I am not your tax advisor. What the tax implications would be if you're owning a foreign company, and a lot of the rules are different, so you need to know where they're based out of to understand their tax implications. But 8 more shares of Nutrien at $60.95. This $880.93 in these new shares added another $41.34 to the portfolio in passive income, annual passive income over the next year. All total, the purchases here, the purchases we made on the previous slide, as well as the dividends paid out, added $70.79 in passive income over the next year. So again, this dividend snowball continues to grow. The total passive income continues to grow week over week. Whether I add new capital, which I still am, or not, the passive income will continue to grow now, and that dividend snowball will continue to grow over time. Next up, we'll run through the sector weights here. Communications sitting at 8.32% of the portfolio. Consumer discretionary is this little sliver right here. That's our 2 shares of Williams and Sonoma from when we were running that wheel on that one. And that is one thing about running cash secured puts and covered calls, right? You can pick up shares, and that's what I did with Williams and Sonoma. Whenever I ran those, when I was still doing the Williams and Sonoma wheel, I used some of the premium to buy those shares. So I basically got those shares for free, right? So those 2 shares, that's what that consumer discretionary right there is. Consumer staples sitting at 5.88% of the pie. Energy makes up 6.99%. ENB, Enbridge, and Enterprise Product Partners are both in this sector. I'd like to add to. I'd like a little bit of a pullback on Enterprise Product Partners, but ENB looks attractive right now, so I may add some to this position here, as well as consumer staples here. My Kraft Heinz position is under my cost basis, so I'd like to build that out a little bit more as well. But let's keep running through this. Financials is sitting at 11.38% of the portfolio. Healthcare, the largest position in the portfolio, as I said, with the purchases of Johnson & Johnson, the recent purchases of Pfizer, the cash secured put I'm running on CVS. This sector, I'm counting those 100 shares right now, even though they technically have not been assigned yet. I am counting those 100 shares of CVS because I want to run that until I actually am assigned the shares. And I want to get the shares under $74 per share. So I'm hoping that they get assigned next week, and then we look at something else maybe to run a wheel on. But anyways, this one is creeping up there. I do not like any one sector to be over 25%. So at some point, I'm going to have to back off of buying Johnson & Johnson, buying Pfizer, and buying CVS. But for right now, I'm not quite there yet, so I'm going to keep on going. But healthcare, 19.06% of the portfolio. Industrials is sitting at 8.73%. I wish Union Pacific would pull back under 200 per share. I would add to that position there. Technology sitting at 9.10. Materials is now the second largest position, sitting at 15.56% of the portfolio. Utilities, still no utilities. I am watching NextEra Energy. I almost pulled the trigger on that one this week. Was down to 71 late last week. It was back up to 73, 74 this week. So we'll see how it goes. I'm still adding to a couple other positions. Johnson & Johnson I liked a little better, as well as Pfizer and the other positions I picked up. So really for the utility, because it's such a slow growing sector, and the companies I'm looking at, they're not really killing it. NextEra Energy is really the big one that I'm looking at. And I'll just wait for the right buying opportunity. I think there's going to be some good ones coming up. I think that sector, if we continue to see the growth in the a lot of the big caps and a lot of the tech names out there, Meta, old Facebook, as well as Apple and Microsoft, I think there may be a little bit of a rotation into those sectors and out of some of these slower growing sectors like utilities, the safety plays. So I'm hoping that there's a protracted pullback there and I can jump in at some point, but we'll see. The REITs and real estate is the last one here. 14.81% is the third largest position of the portfolio, sitting at 14.81%, and no REITs or no ETFs and no index funds here. I consider the whole portfolio its own index fund or ETF there. My personal ETF, let's call it the vested interest ETF. So we could call it if that's okay. Portfolio sector weights a little bit different. You look at them here, and then you can look at the monetary value associated with each position as well. Just a different way to look at it versus the percentages over on the left. And what you all probably really are interested, the overall portfolio update. I show this every Sunday morning so you can see exactly how I'm building out this portfolio in real time, week to week, what positions I've added. If I sell any, I'm showing you that. If I'm down, if I'm up, I'm showing you that, where I'm down, where I'm up. Right, here's the ticker. These are all the positions in the portfolio, the total shares of each position, current price as of the close of business on Friday, current market value, again, at the close of business on Friday, average share per, this is my cost per share, and the average purchase price, this is my average share price times how many shares I own, right? So that's why these don't line up with the market value, right? Total return, whether I'm up or down. Percent return, whether I'm up or down. If I'm in the red on either one of those, it means I'm down. If I'm in the green, and the brighter green it is, the more I'm up, right? So you can check out some of my biggest losers. Siboney Stillwater down 22%. AT&T, yep, down 19%, and Verizon down 20%. So that might be part of the reason I continue to add to those too. I try to bring my cost basis down and increase the dividend payout yield. But sectors that they're in, quarterly or monthly semi-annual payers, their current dividend yield, my yield on cost, the portfolio weighting. So what we saw on the previous slide was the sector weightings. This is the weighting per position, estimated annual income, payout months, dividend growth year over year. This changes over time, so this is not static. I usually check this out at least once a quarter. A lot of times it's once a month just to make sure I'm staying on top of it. And where it sits, 15% of its 52-week low. So I talked about CVS here, right? And technically, like I said, I'm counting 100 shares. I own 10 shares. I'm counting 100 shares that I'm running that cash secured put on until they're assigned. So what I'm looking at here, at 15% of their 52-week low, that's $76.29 per share. So really, I said CVS, I'd like to get into CVS under 74 per share. And that really is where I'd like to be at. But I'm comfortable all the way up to $76.29 because that's 15% of its 52-week low. Now, that's just an arbitrary number. You could use 10%, you could use 20%, you could use 5%. I just kind of chose 15% because if it's within 15% of its 52-week low, I feel like I'm at least getting some value. Yep, I didn't get the bottom. And a lot of times whenever I sell, I don't sell at the top. And I'm all right with that. I can't remember exactly who said it, but I read it a long time ago. And an investor, his statement was, I may miss out on the bottom by 20%. I may miss out on the top by 20%, but I am perfectly comfortable living in that 20 to 80% range. So if I can make 20 or 80% on my money, I'm perfectly comfortable with that. And that kind of always stuck with me. So I picked 15%. So I'm comfortable if I'm within 15% of the bottom, and I'm comfortable if I'm within 15% of the top selling. That's kind of where I'm at. You pick the numbers that make sense for you. That's just where I'm at. Now you can pause this and go through these, right? But I'll run through the totals. Current total shares, 4,305.048. Current market value, $150,360.86. My purchase price, what I have into it, $151,671.78. I am down $1,310.93, which amounts to 0.86%, right? So just under 1% I'm down. Current yield of the portfolio, 4.871%. My yield on cost, 4.829%. And really, this is what I'm focused on. This is what it's all about. This continues to grow week over week, month over month, year over year. That dividend snowball in effect, whether the market's up, whether the market's down, whether the market is floating sideways. I'm really focused on the passive income provided by the positions within the portfolio, and it currently sits at $7,324.29. So very nice to see. Continues to go up week over week. I'm really looking forward to breaking. I think by the end of the month, we'll be real close to breaking over 7,500 annual income here, and it should be, if it continues on the route it is right now, very close to being in the 9 to 10,000. I'd love to break 10,000. I don't think we will quite get there, but really should break 9 to 9,500 by the end of the year. Be very close to 10,000. If not breaking it by the end of the year, be breaking it by the end of the first quarter easily next year. And here is the last one, dividend growth year over year. If you averaged all that out, 7.99%. So again, if I was to stop adding new capital, just the dividend itself would grow by 7.99% over time. This number here would grow by 7. That doesn't count the price appreciation for any of the stocks. That's just the dividend growth overall. Well, that is really it for this one. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey to financial freedom. Join the vested interest community, building a community of like-minded dividend growth investors so that we can share our experiences, stocks we're watching, stocks we're avoiding, just anything in the dividend investing community. Tips and tricks that we picked up along the way, like options, like the dividend wheel strategy, stuff like that we can share with each other and help each other become better investors. We can all learn from each other, right? I'm not the smartest guy in the world. I did not go to school for this. Some of you out there may have gone to school for this and have some things that you could share that I have no idea about, right? like options, for example. I don't know what a butterfly option or some of the other option strategies that are out there. The wheel strategy I've read up a little bit about on, and that's one of the ones that I am doing right now, right, where you sell a cash secured put. If you're assigned the shares, then you sell a covered call. So that's the one that I am running right now as a way to supercharge that. And I learned that watching other dividend YouTubers out there. The Average Joe Investor, he's one of ones that I watched do that. So seems to be working out pretty well so far. Really appreciate that. So again, a lot of good information out there, not just on this channel, but others out there. Really enjoy the dividend growth investing community. Really appreciate all of you out there. I do personally read and respond to the comments. I'm always interested in your questions and or opinions. So if you have stocks you'd like me to cover in the Stock Pick of the Day series, tell me what stocks you picked up this week. Do you run options? Did anyone pay you dividends this week? I'd love to hear all of that. Drop it down in the comment section down below. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by, and we'll see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion that investing journey for educational and entertainment purposes. Investing involves risk and Kansas money should never invest any amount not comfortable losing. Always do your own research and invest based on your situation, circumstances, and select criteria, or seek the advice counsel of a certified financial advisor.